Welcome to the last great American exit. For a growing number of Americans, the problem isn't that life has collapsed overnight. It's that it no longer feels stable in the way it used to. You may still be working. Your income may still be coming in. On the surface, nothing looks dramatically wrong. But month after month, it feels harder to stay comfortable. Bills take up more space in the budget. Credit card balances don't come down as easily. Unexpected expenses don't just annoy you anymore. They force decisions. That disconnect is what makes this moment confusing. We keep hearing that the economy is holding up. Growth is still positive. Jobs still exist. But lived experience tells a different story. For many households, the pressure isn't coming from unemployment or sudden loss. It's coming from the slow erosion of financial breathing room. This is not a story about irresponsibility. Most people didn't suddenly change how they live. What changed were the costs around them. Housing stayed expensive. Insurance rose. Healthcare costs crept higher. Food and utilities never really came back down. Over time, those increases turned normal budgets into tight ones. What we're seeing now is the next phase of that adjustment. People aren't giving up all at once. They're adapting quietly, stretching payments, leaning on credit, and deciding which obligations matter most each month. Those choices don't show up immediately in headlines, but they reveal a deeper shift in household finances. The shift in household debt. This breakdown is about understanding that shift. Household debt has become such a familiar part of American life that it no longer feels alarming on its own. Mortgages, car loans, credit cards. These things have existed for decades. What's changed is not the presence of debt, but the role it now plays in everyday survival. Total household debt has reached record levels, but that headline misses the real issue. The problem isn't that Americans suddenly took on debt irresponsibly. The problem is that debt has shifted from something people used to build a life into something people now use to maintain one. In earlier periods, borrowing typically followed income growth. A raise came first. A home upgrade or major purchase came later. Today, that order has flipped for many households. Costs move first. Income struggles to catch up. Debt fills the gap. Credit cards are the clearest example. They were once a convenience used briefly and paid off quickly. Now for many households, they function as a pressure valve. When groceries cost more, when insurance premiums jump, when a medical bill shows up, the card absorbs the shock. Not because people wanted to, but because there's no other place for that cost to go. This is especially true for households that would traditionally be considered stable. Middle-income families often don't qualify for assistance, yet they face many of the same rising costs. Over time, savings built in earlier years have been drawn down. What replaces those savings isn't new income, but revolving balances. The danger here isn't sudden collapse, it's dependency. When debt becomes embedded in routine expenses, households lose flexibility. Every dollar of income becomes partially pre-committed not just to living costs, but to interest and minimum payments tied to the past. That makes budgets less responsive and mistakes more expensive. This is why household debt today feels different than it did in previous cycles. It's not concentrated in speculation or luxury. It's spread across normal life. The disappearance of margin systems, built on thin margins, don't break immediately. They strain quietly until something small pushes them past their limits. One of the biggest changes in household finances over the past few years is on something most people track directly. It's not a single bill or a single number. It's the disappearance of financial margin. Financial margin is the space between getting by and falling behind. It's the extra money left at the end of the month. It's the savings account that can absorb a surprise. For a long time, many households had some version of that margin, even if it wasn't large. A car repair didn't immediately create stress. A higher utility bill didn't force trade. That buffer made everyday life feel manageable. Today, that buffer has thinned or vanished for a growing number of people. The reason isn't dramatic overspending. It's that fixed costs have quietly expanded. Housing takes up more of the paycheck than it used to. Insurance premiums, home auto, health have climbed and stayed elevated. Medical costs are less predictable. Even basic services now consume a larger share of monthly income. When fixed costs rise, margin shrinks. And when margin disappears, flexibility goes with it. That's when small problems become big ones. A dentist visit isn't just inconvenient. It disrupts the month. A delayed paycheck creates a chain reaction. One unexpected bill forces another bill to wait. The household isn't failing. It's juggling. This is the stage where financial stress becomes visible in behavior. Even if everything still looks normal on the outside, people don't cancel everything at once. They postpone. They rotate balances. They lean a little harder on credit. They tell themselves they'll catch up next month. Sometimes they do, sometimes they don't. The signal in delinquencies, the loss of margin, is what turns ordinary households into fragile ones. Not fragile in the sense of collapse, but fragile in the sense that they can no longer absorb shocks without consequences. And once enough households reach that point, the broader economy begins to feel it. Not through headlines, but through patterns that repeat quietly across millions of lives. That's the bridge between rising debt and what comes next. Delinquencies don't appear when people stop caring. They appear when people start choosing. A missed or late payment is rarely the first sign of trouble, but it's often the first visible one. By the time a household becomes delinquent on a bill, a series of quiet adjustments has already happened behind the scenes. Spending has been trimmed, savings have been tapped, credit has been leaned on. Only then does something finally slip. This is why delinquencies matter more than dramatic statistics like bankruptcies or foreclosures. They show stress while people are still trying to hold things together. Most households follow the same hierarchy when money gets tight. Housing comes first. Rent or mortgage payments are protected as long as possible. Utilities follow close behind. Food is non-negotiable. What gets pushed back are the obligations with the most flexibility. Credit cards, personal loans, sometimes auto payments. These are not decisions made lightly. They're decisions made to keep life functioning. What's changed recently is how widespread this behavior has become. Delinquency rates have been rising across multiple categories, not because people suddenly became irresponsible, but because more households have reached the edge of their financial margin at the same time. And this trend is no longer confined to the lowest income groups. Middle-income households, people who are still employed and still earning, are increasingly part of the picture. That's an important shift. When delinquencies are isolated, the system absorbs them easily. Lenders adjust credit scores, dip life, Mobies, on. But when delinquencies spread, they become a signal that household finances are under collective strain. It means people are making trade-offs they didn't have to make before. Historically, this pattern shows up before broader economic weakness becomes obvious. Employment can remain stable for a while. Spending can continue, though more cautiously. But beneath that surface, the foundation is weakening. The stack of returning pressures, delinquencies are not the crisis. They are the warning. They tell us that the financial system is no longer running on comfort or excess. It's running on prioritization. And when millions of households are forced into that mode at once, the consequences don't stay contained. They ripple outward slowly, but persistently. For many households, financial stress didn't come from one large shock. It came from old obligations returning at the worst possible time. Student loans are a clear example. For years, those payments were paused or reduced. Households adjusted around that absence. Budgets adapted. Other expenses expanded to fill the space. When student loan payments resumed, they didn't arrive as a new cost. They arrived as a reminder that the margin people thought they had was already gone. For some borrowers, the monthly amount wasn't even that large. But timing matters. When budgets are already tight, adding back even a few hundred a month forces trade-offs elsewhere. The result isn't always default on student loans themselves. It's pressure that shows up in other places. Credit cards, savings, or delayed payments. Auto loans have followed a similar path. Car prices rose sharply and never fully corrected. Interest rates climbed. Monthly payments grew. For households that need a vehicle to work, transportation isn't optional. The payment becomes fixed even as everything else around it becomes less predictable. What makes this combination dangerous is not the size of any single obligation, but how they stack. A student loan payment here, a higher car payment there, insurance premiums rising in the background. None of these alone break a household. Together, they compress the budget until flexibility disappears completely. This is how pressure spreads quietly. One bill doesn't get paid late because it's unimportant. It gets paid late because something else took priority. And that prioritization becomes harder as more fixed costs compete for the same limited income. These returning pressures also help explain why delinquencies can rise, even while employment remains relatively stable. People are working, they're earning, but they're carrying more obligations than their income can comfortably support. Why? The data is misleading. One reason the current situation feels so confusing is that the economic data most people hear about does unline up with how life actually feels. Gross domestic product (GDP) is still growing. Consumer spending hasn't fallen off a cliff. From a distance, the system looks functional, but activity is not the same thing as health. GDP measures how much money moves through the economy, not where that money comes from or how sustainable that movement is. When someone spends cash, GDP rises. When someone spends on a credit card, GDP rises the same amount. When a bill is paid with borrowed money or deferred through a payment plan, GDP still counts it as growth. That distinction matters more now than it has in a long time. Over the past few years, consumer spending has increasingly been supported by credit rather than rising real income. Savings built earlier were used up. What replaced them wasn't stronger wages, but borrowing from the outside. Spending continued, but the quality of that spending changed. This helps explain why places can look busy while households feel strained. A full restaurant doesn't tell you whether the meal was paid for comfortably or carried forward. A crowded store doesn't reveal whether the purchase fits within a stable budget or adds to a growing balance. The American cost of living has shifted in a way that GDP doesn't capture well. More income now goes toward essentials that don't improve quality of life: housing, insurance, healthcare, and basic services. That leaves less room for discretionary spending unless households lean on credit to fill the gap. So when spending eventually slows, it's not because people suddenly lose interest. It's because the financing behind that spending becomes harder to maintain. Credit limits are reached. Minimum payments rise. Lenders tighten standards. The same spending that once supported growth starts to fade. GDP doesn't fail in these moments. It lags. It reflects what has already happened, not the strain building underneath. By the time it clearly weakens, households have often been feeling the pressure for quite a while. That's why relying on surface-level growth numbers can be misleading. The economy may still be moving, but many households are doing so with far less stability than before. The new baseline, one of the most frustrating parts of the current environment, is that inflation feels like it's over. Yet life never got cheaper. Prices stopped rising as fast as they once did, but they didn't come back down. That distinction matters for households. What counts isn't the rate of increase. It's the level, and the level of everyday costs reset higher and stayed there. Groceries didn't return to their old prices. Insurance premiums didn't reverse. Healthcare costs didn't ease. Utilities didn't shrink. Instead, they stabilized at a higher baseline. That new baseline quietly reshaped monthly budgets, turning what used to be manageable into something much tighter. At the same time, interest rates stayed elevated. High rates were supposed to be temporary, a tool to bring inflation under control. But as rates remained higher for longer, they became part of daily financial life. Credit card balances became more expensive to carry. Auto loans stayed costly. Home equity lines and personal loans lost their flexibility. Even households that avoided new borrowing felt the impact through higher minimum payments and reduced options. This combination is what makes the current period feel so different from short inflation scares in the past. When prices rise quickly, but then fall, households can recover. When prices rise and stick while borrowing costs remain high, the pressure becomes structural. It doesn't go away with patience. It demands adjustment. For many Americans, that adjustment has already happened quietly. Spending habits changed. Discretionary purchases were cut back. Savings contributions slowed or stopped. What didn't change were the fixed costs. Those stayed locked in. That's why the squeeze feels persistent. It's not tied to a single bill or a single year. It's built into the system people are now living inside. Every month starts closer to the edge than it used to. The lag effect, one question that comes up a lot is why all of this feels so real now, even though many of the underlying changes started years ago. The answer lies in something called the lag effect. Economic policy doesn't hit households immediately. When interest rates rise or financial conditions tighten, the impact spreads slowly. It takes time for old loans to reset, for savings to run down, and for higher costs to work their way fully into everyday budgets. In the early stages, Mortgages are locked in at lower rates. Savings are still available. Credit limits haven't tightened yet. Life feels uncomfortable but manageable. That's why for a while it seemed like the economy could absorb higher rates without much damage. But buffers don't last forever. As time passes, loans roll over. Credit card balances grow more expensive. Auto loans renew at higher rates. Savings that once acted as shock absorbers get depleted. What was once temporary support quietly disappears. That's when the lag effect becomes visible, not in headlines, but in behavior. People stop planning long-term purchases. They hesitate before committing to anything new. They become cautious, not because they're pessimistic, but because experience has taught them that their margin is thinner than it used to be. Businesses sense that hesitation and adjust accordingly, scaling back expansion plans and becoming more conservative. This delayed response is why the economy can look resilient for a long time and then suddenly feel fragile. The damage isn't sudden. It's cumulative. Each month of tight conditions adds a little more strain until the system reaches a point where even small shocks matter. The slow grind, when people ask what comes next, they often expect a clear turning point to crash. A headline moment. A signal that things have officially gone bad. But that's rarely how this phase of an economic cycle unfolds. What's more likely is a slow grind. Spending doesn't collapse, but it weakens. Households continue buying necessities while pulling back on anything optional. Businesses notice the change not through panic, but through softer demand and slower turnover. Hiring becomes more cautious. Layoffs happen, but in smaller, uneven waves rather than all at once. Credit plays a major role in this stage. Lenders become more selective. Standards tighten quietly. Limits don't always drop overnight, but approvals become harder. For households already stretched, access to credit becomes less reliable right when it's most needed. The lag, in fact, one question that comes up a lot, is why all of this feels so real now, even though many of the underlying changes started years ago. The answer lies in something called the lag effect. Economic policy doesn't hit households immediately. When interest rates rise or financial conditions tighten, the impact spreads slowly. It takes time for old loans to reset, for savings to run down, and for higher costs to work their way fully into everyday budgets. In the early stages, mortgages are locked in at lower rates. Savings are still available. Credit limits haven't tightened yet. Life feels uncomfortable but manageable. That's why for a while it seemed like the economy could absorb higher rates without much damage. But buffers don't last forever. As time passes, loans roll over. Credit card balances grow more expensive. Auto loans renew at higher rates. Savings that once acted as shock absorbers get depleted. What was once temporary support quietly disappears. That's when the lag effect becomes visible. Not in headlines, but in behavior. People stop planning long-term purchases. They hesitate before committing to anything new. They become cautious, not because they're pessimistic, but because experience has taught them that their margin is thinner than it used to be. Businesses sense that hesitation and adjust accordingly, scaling back expansion plans and becoming more conservative. This delayed response is why the economy can look resilient for a long time and then suddenly feel fragile. The damage isn't sudden. It's cumulative. Each month of tight conditions adds a little more strain until the system reaches a point where even small shocks matter. The slow grind, when people ask what comes next, they often expect a clear turning point, a crash, a headline moment, a signal that things have officially gone bad. But that's rarely how this phase of an economic cycle unfolds. What's more likely is a slow grind. Spending doesn't collapse, but it weakens. Households continue buying necessities while pulling back on anything optional. Businesses notice the change, not through panic, but through softer demand and slower turnover. Hiring becomes more cautious. Layoffs happen, but in smaller, uneven waves rather than all at once. Credit plays a major role in this stage. Lenders become more selective. Standards tighten quietly. Limits don't always drop overnight, but approvals become harder. For households already stretched, access to credit becomes less reliable right when it's most needed. This environment doesn't feel dramatic. It feels tiring. People delay decisions. They avoid taking on new obligations. They focus on maintenance instead of growth. That mindset spreads across millions of households, and when it does, economic momentum fades, even without a formal crisis. The key point is that this kind of slowdown isn't evenly distributed. Households with lower debt and stable expenses still have options. They can adjust without severe consequences. Households with high fixed costs and little margin feel every shift immediately. That's why this period feels so uneven. Some people appear fine, others feel constant pressure. Both experiences can exist at the same time, even within the same economy. Conclusion: clarity over panic. If there's one takeaway from all of this, it's that the financial pressure many Americans feel right now isn't imagined, and it isn't a personal failure. This moment is the result of rising costs, tighter financial conditions, and years of adjustment that quietly reduced household flexibility. People didn't suddenly start making bad decisions. They adapted to an environment that changed faster than their income could. Understanding that matters. When you see headlines about growth or spending, it helps to remember what those numbers don't show. They don't show how thin margins have become. They don't show the trade-offs happening behind closed doors. And they don't show how much effort it now takes to simply stay even. This isn't about panic or predicting disaster. It's about clarity. Lower debt creates more freedom. Lower fixed costs create more resilience. Knowing the difference between surface-level stability and underlying strain helps people make calmer, more deliberate choices. Periods like this reward caution, patience, and realism. They don't favor extremes, neither blind optimism nor constant fear. If this breakdown reflects what you're seeing in your own life or around you, you're not alone. And if you want more clear, grounded analysis that focuses on reality rather than headlines, consider subscribing so you can stay informed without being overwhelmed.